let's take a look at the Asian markets because we're getting the early rates and it's not looking good. Once again, losses are led by the Japanese market.
330 billion of Indian bonds become eligible, but that doesn't mean all of them, of course, will be bought.
The promoter entity Glenmark Pharma is selling 75% stake in the company to Nirma Limited.
Now, yesterday when we went from 4.23 to 4.33, Indian bonds stood pat. So some of the good news is there.
The company has seen a lot of senior level exits in the last 1 year or so.
First take on the index, it's in flat terrain.
Some point of time in the near future, many of the PSU banks will also come for equity raising.
How much money are we really talking in terms of what can come because of passive funds?
They have taken a decision and it shows their confidence in the economy.
In next year and 2026, we would have added all of these 600 rooms.
So we expect the revenues to grow in very, very high double digits.
Now markets are virtually back at the day's high.
The government says that this is not an import restriction mechanism.
Citi has raised their target price on Maruti to 13,600. The market is so very, very quiet today.
That was the day so far. Hello and welcome to Closing Bell live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me are Sonia Shenoy and Nigel D'Souza. Guys, the final 1 hour of the trading day and the week. And today has been quite the volatile session, right? Pull up that intraday chart. The Nifty, first opened up pretty okay on the flatter side, then it recovered, then it slipped a bit. And again, now from the day's high, it's been quite the fall. On the Nifty Bank, the picture is also even more stark. The Nifty Bank had a recovery of close to 450 points from the day's low. And after that, from the day's high, it slipped another 200 points. In that sense, it's a bit disappointing considering we had positive cues in the form of those, the global bond, India getting included in the JP Morgan Emerging Market Index, and yet the markets have slipped from the day's high. And global markets, too, are not as bad as what was feared when we had Wall Street closing up. This is the week-to-date, performance for the key indices. It's been a tough week for us, no doubt.
A tough week, but did you hear the way Nigel smiled when he said it's the last 1 hour of the day and the week? I think I'm just waiting for this one to get done, right?
It's been an exhausting one.
And we are not done just yet. I mean, we'll be done at 5 p.m.
Yeah, we have editors roundtable after this. We're looking forward to that. But, good to end the week at least on not such a bad note. Because at least I'm hoping by the end of today, maybe we get into the green. And today, periodically, there have been some buy-on dips that's taken place, which is pretty good news. The Nifty, though, has almost gone to around that 19,800 odd mark. And it's faced some resistance at that mark. If you pull up the intraday chart, you'll see on the Nifty, we almost went there. And from there, we saw a bit of a U-turn. The problem is with the Nifty Bank, because that was trying to conquer a couple of technical marks. That's the 20 DMA as well as the 50 DMA. And it actually went to those levels and from there did a U-turn. To be precise, 44,950 approximately. Where's the 50 DMA and where's the 20 DMA as well? And from there, we did a turnaround. That's a technical factor at play. On the option side, 19,800 call, 19,700 put. Both of them have the highest open interest, and there's a big amount of open interest built up today. So you got your tight range. On the downside, you're looking at the 19,625. On the upside, 19,900, since you're seeing writing at around that 19,800 call also. So yeah, we are bracing for the last 60 minutes or so and waiting to get through it.
Okay, waiting to get through it and go home, right? I mean, and spend the weekend. But you also have the Nifty that has fallen 2.5% this week. So in a way, this is this has been a weak week for global markets and for our own markets. But let's continue our coverage on the big positive that we got through for the index, which is the inclusion of Indian bonds in JP Morgan's Emerging Market Debt Index. We have another special guest joining us to tell us what the implications of this would be. Sanjeev Sanyal, the member Economic Advisory Council to the Prime Minister of India, is joining in. And Lata is also here to take us through that discussion. Lata, over to you.
Thank you very much, Sonia. And Sanjeev Sanyal, thank you very much for joining us. Well, in a way, it's congratulations to you. Were you not party to the team that actually devised the fully accessible route so that the bond inclusion becomes a reality? First thoughts?
Well, I mean, this has been in the works for some time, so it's good that finally it came through. As you know,
I don't think we can hear you, Sanjeev.
Can you hear me now?
Please repeat yourself.
Yeah. So, I mean, it's been in the works for some time, so it's not a complete surprise. As you know, this has to go through several processes, both on our side as well as on the investor side. So all those processes had to go through. So now we are now in place for the inclusion. And so From what I gather, it will eventually go up to about 10% of the JP Morgan EM index, which accounts for about, as things stand, about $24 billion worth of inflows. Now, do remember that this is not the only index. There are several other indices like the Barclays Bloomberg one, there is an FTSE one, and so on. So there are other indices as well. And so assuming that over time this kind of becomes generalized and we become a normalized part of the global indices, then this can account as much as something like $40 billion worth of inflows. And they tend to be reasonably stable compared to other forms of indices because this is a passive form of investing. Monies are put into the proportions. And yes, those percentages go up and down. So it's not like it's completely stable. But compared to most other sources of inflows, these tend to be reasonably stable.
Now, as an economist, what do you see as the macro benefits?
Well, this is, let's not blow it out of proportion. This is one more form of inflow and access to capital that we have. In the long run, it positions ourselves as part of the global economy. It lowers the cost of capital in India, both for the government, but overall as well. So in that sense, it is good for bringing down the cost of capital in India, something that is historically been high by the standards of most of our export competitors. So in that sense, it's good. And of course, for the fiscal as well, because these are government bonds. So they will now be at a lower interest rate than would have otherwise been the case. So in that sense, the interest cost into the future will be lower than would otherwise have been.
But would investors even perceive that the twin deficits, current account and fiscal deficit, are more manageable now because there is a large, deep-pocketed set of investors who are coming? So perception of macros should improve, you think?
Well, as with all these things, you tend to have these things go in virtuous cycles. So because you get cheaper capital, so therefore your economic growth is better, your ability to, repay them is better because you're getting this at a lower interest rate, and so on and so forth. So as with all these things go into virtuous cycles. So this is one more sort of step in that direction. In itself, it wouldn't be worth very much, but as you just yourself mentioned, we are in a good macro situation. Our current account is well managed. By historical standards, our inflation has been well managed over the last many years. Growth is good. Debt to GDP ratios are coming down. So overall, we are in a good position.
This increase the Reserve Bank's headache in terms of, an appreciating currency. From the Chinese yuan is, depreciating or has depreciated a lot over the past 12 months. And we have a big deficit with that country. So they will have to work overtime to keep the rupee from appreciating too much?
Well, we have a well-established way in which we handle the exchange rate. And we will continue with that, which is that more or less in the medium term, we let the rupee find its level. But yes, we do lean against the wind in both directions, both up and down. And that's why the foreign exchange reserves worth of 600 billion is there. And we are not afraid to use that, as you have seen. So I don't think there'll be any change in the way the Reserve Bank will manage the rupee. It will be allowed to find its own level in the medium term with, as I said, use of reserves to lean against the wind for short-term fluctuations.
Made the calculation that there's $22 billion because of the inclusion into the JPM bond index. And then if Bloomberg, Barclays and FTSE Russell were to do just the same, it's about $40 billion. Do you think now active funds, will now look at this as a great reason to front run? Do you think we can get another $10 billion simply because active funds will apportion more?
That may happen. But that tends to be opportunistic. So those funds tend to come in and leave. And sure, our markets have now become much more liquid. We have a lot more depth. So we can we can deal with those kinds of fluctuations. But these index-linked bond, whether it's equity or debt, money tends to be much more stable. And so we tend to have a preference for these more passive, slow-moving money. than would be the active ones which go in and out at the back of an eyelid. So I think as a general principle, we prefer slow money. This is not to suggest that, we are not a part of the market economy, and some volatility is also okay. But as I said, this particular source of funds is good because it tends to bring in slow money, because this tends to be tied to this a weightage in the bond, and except in very extreme situations, these things don't move around too much.
I agree with you. Of course, these are passive funds, and therefore it's more or less a given, and therefore more reliable. Any back-of-the-envelope calculation on how much the cost of capital or the interest burden can come down? I mean, do you think it's a 25 basis point fall in the cost of money for the government of India, or even more than that? Could it be, well below 7% for the 10-year?
No, you can't calculate those kinds of things. Many people will make these models and claim them. I can assure you, having worked in financial markets for 2 odd decades, none of those models give you any reasonable forecast. So we know that it will be somewhat or significantly lower than what it would have otherwise be, but it's impossible to put a hard number to it.
Okay. What's the next big or next important step that you are looking forward to in the bond markets to make them, more robust, more deep, more widely traded?
Well, I'm not looking at any specific measure at this one juncture. Our approach throughout has been feedback loop and adjust small incremental changes. So we keep doing those things, and it has served us well, because it means that we can keep improving things without having to do any radical changes to the system, because the system overall now works. We are not in the 1990s or the 2000s where the market itself didn't exist. Now we have a well-established market. There are well-established players. Their rules are more or less clear. So we can get away with making incremental changes. Over time, those changes add up, and I would continue to be, with that approach.
Okay. Time permitting, I'll come back to the bond markets, but there was another piece of data that came out from the Reserve Bank when it released its bulletin last week. We discovered that our household financial savings net have fallen to a 47-year low. That's because financial indebtedness, household financial loans have gone up. Would that be a cause of bother? Do you think that could be a constraint on growth?
Not in any specific way. I mean, what came across is that Indian households had a preference for physical assets like real estate and so on. And that may be an utterly realistic thing for Indian households to do. What we care for from a macro stability perspective is overall savings. So in the end, why do we care about this? Because the difference between our investment rate and our savings rate is the current account. And if we try to invest faster, but we do not get more savings, we will end up with a large current account deficit and have external problems. So from a macro stability perspective, we do care about whether or not the overall savings rate is going up or down. Specifically for the financial sector vis-a-vis other assets, all I will say is that that may matter for the specific sector. So, for example, the insurance people may care whether savings are coming to insurance, or the equities people may care whether savings are coming to equities. But for the macroeconomist or the overall managers of the economy, it is not that significant an issue.
Just a final set of questions on the global situation. The US bond, 10-year bond yield has now gone to 4.5%, a level we have not seen perhaps maybe since the time you were in the markets, maybe 2005 or thereabouts. Is that a bother? You think that can, this global rise in the cost of capital can be a constraint to growth? We too can't push our yields too much lower if the global cost of capital is that high, you think?
It's certainly a concern that the cost of capital in the rest of the world has gone up, and they've had to tighten so sharply. Indeed, we had warned the rest of the world very clearly during the COVID period not to go out there and splurge on their monetary and fiscal levers in the way they did, warning them exactly what would happen, which is that they would end up indebted and with high inflation. But now that they have had to do this tightening, it is annoying because it does mean that global liquidity is tighter than would otherwise have been. And, they are attempting to slow down growth, and therefore global trade and so on have also been impacted. So in that sense, it is something that could have been avoided. Also important from the perspective of some of these Western countries in particular, what is happening is that as they continue to tighten, but not carrying out adequate fiscal corrections, it is also stressing their financial system, a point that I have also made repeatedly. For example, in the US, they have continued to have what I think is still reasonably loose fiscal policy. And they're continuing to compensate for it by ever tighter monetary policy. And not surprisingly, that is causing stress to their banks. And you keep hearing small banks going bust all the time in the US. So this disbalance is something that the Western macro managers, whether fiscal or monetary, need to do something about. And unless they rebalance this, we will continue to be in this curious position. So I think what we really need is, the mix between fiscal and monetary has to be rebalanced in the North Atlantic, and that would be good for everybody. And of course, there is the other issue of global oil prices, which are also, I think, unnecessarily high. They've gone up well past $90 per barrel again. And I think here it would be good to see oil producers to come together, including OPEC, to look at how to ease energy supplies and bring them back again.
That was going to be my last question. Given those kinds of headwinds, do you think that the 6.5% growth that is the Reserve Bank's target, and I think the assumption of the budget as well, is a bit of a stretch this year?
No, we have been conservative in that throughout. As you know, we have kept saying 6.5% to 7%. The first quarter number, as you know, came out at 7.7%, so well above this target range. But we have made the point throughout that the first quarter did benefit a little bit from a statistical factors, but nevertheless, the momentum is there to be able to get within the 6.5% to 7% range. So although the headline number will come off in the next few quarters, the growth momentum remains strong. And, whether it's in services, but even in, corporate investing and other things, we are continuing to see reasonably good, strong numbers. Every month you see the PMI numbers, they're super hot. You look at many indicators, corporate profitability or whatever else you want to see, GST numbers, they all tend to suggest that there is good, solid momentum in our economy, despite the fact that the external environment is not so conducive.
We'll leave that on that high note. Thank you very much, Sanjeev Sanyal, for joining us on what's a very big day for the Indian bond markets. A big investor, the set of passive emerging market debt funds now more likely to buy and pour in, as Sanjeev Sanyal said, $20 billion to $40 billion in the next 12 to 18 months. Thank you very much, Sanjeev Sanyal.
Thank you.
Right.
Over to you, Sonia.
Thanks a lot, Lata, for that. And as Sanjeev Sanyal said, right, this is just one more form of inflow and access to the capital markets, to capital rather. So, of course, good for our country. Thanks a lot for that. Let's slip into a quick break. On the other side of the break, we have about 45 minutes left for the markets to close for the day. There's a little bit of, trepidation in the market as we speak. Prakash Diwan will join in for some stock talk. We'll also be joined by our Alpha manager, Amit Gupta of ICICI Securities PMS, coming up in a bit. Welcome back. We're just counting down to the last, half an hour of trade of the day and the week. And looks like it's not going to end too badly. We're going to end with cuts of anywhere between, less than 0.5% actually on the sensex Nifty and the mid-cap index. The bank Nifty, though, is trending in the green. You have Prakash Diwan joining in now to give us a view on which way things are headed. Prakash, I think the stocks of the week have been these, PSU banking names. Although some of them are still ending the week, much higher. So there's Union Bank, there's IOB, which is up 10% this week. South Indian Bank is up 9%. But in the middle of the week, we did see some amount of profit taking as well. So it's become a little bit of a volatile lot. From here on, if you missed out on this move, is it still worth taking a bet on the likes of maybe SBI or BOB?
So, Sonia, my sense is while the secular trend in the PSU banks remains intact, these bouts of profit taking will naturally be triggered by any news flow that could kind of, impinge on this growth expectation that most of them have. Remember, we've seen repair happen. That's been priced in or that's been factored into the prices, the market prices. We've seen a lot of the balance sheet shoring up that's now likely to start, and that the first indications have come in. And if credit growth continues to, be at this pace, a lot of the smaller banks would also be able to participate in the growth. Right now, it's an expectation and a promise and a hope. It's not yet translated to the numbers because we've seen even the larger ones have struggled with a bit of credit growth continuity of sorts. So I would still stick to the larger ones, be it a Bank of Baroda, be it, of course, SBI, be it a Can Bank. You'll probably have less volatility also supporting you there. But, there was one bank that we spoke about some time back, and that was Bank of Maharashtra, given the fact that it's a special situation kind of a thing, a potential divestment candidate and a turnaround to boot. That's where, I think there are people who have made good money. It's moved from 27, 28 to all the way to 50. And it's probably close to that level right now. So you'll have to take some bets which are stock specific or bank specific. Otherwise, I think the trend continues to grow, to be very positive, but probably at a slightly moderate rate than what we've seen in the last 6 months.
Okay, Prakash, do stay on. Samhi Hotels, pull up that listing. It started off trade absolutely flat, but now it's picking up. The stock has surged close to about 11%. So now it's looking pretty good. This is as I said, the debut was a bit subdued on the exchanges. It listed with gains of about 6%, but now it's picked up. We had a chat with Ashish Jakhanwala, the chairman, MD and CEO of the company. Listen into what he had to say.
We've also taken a bold step of significantly deleveraging the balance sheet. So the IPO proceeds of 1,200 crores mostly go towards deleveraging the balance sheet. So what you would see, we've seen really good income growth. Our EBITDA growth between FY20, FY23 has been from 172 crores to 311 crores. So we have unlocked value in our P&L. Recapitalization of the company through the IPO also starts unlocking value in the balance sheet. And therefore, you would see company very rapidly moving towards profitability, creating free cash, which can then be used also for propelling future growth.
Okay, the other one which listed today is Zaggle Prepaid Ocean Services. That's the other stock, which also a subdued listing. In fact, even now it's down 1.5%. We had a chat with Raj Narayanam, who's the executive chairman of the company. Listen into what he had to say.
I think this year currently we are already, cash flow positive, in the current year. And, what we expect, that was like one-off, because you have to do March 31st and that's how, the receivables were high. But, we are constantly working on, the working capital needs. And I don't think, ours is a business which doesn't require too much of working capital. And what we hope is that, it is going to significantly come down, in the coming months, quarters, years.
Okay, those are the two new kids on the block. By the way, the Nifty Bank has moved into the red. And that's disappointing, actually. Because, if you're looking for a bit of a relief rally today, the Nifty Bank had to play its role. Initially, it did. At one point of time, we almost went to around 19,800. But the Nifty Bank has moved into the red. And that's the bit of an issue. But, Prakash, you gave us a view on a couple of these financial names. I wanted to ask you about these power ancillaries, so to call it. The power sector, yes, there's plenty of demand out there. But we've been talking about these themes. REC, PFC, they played out so well. In the last 1 hour or so, those stocks have moved to the high point of the day while the markets are still jittery. There's smart meter players as well, like Genius Power. That stock for the second day running, it was doing virtually nothing in the first half of trade. And that one as well has spiked up. anything you like from these, either REC, PFC or Genespa? And I ask you this because these stocks have already run up a goodish bit.
No, absolutely, Nigel. So, but, when you hear the management of some of these companies, and specifically, I remember listening into the REC management a couple of days back on your channel, it was very clear that there is a huge level of confidence and visibility on earnings going forward. And, they're talking about being able to maintain margins, AUM also growing, and cost of funds, which has been the most elevated in recent years, it's probably only going to be flattish or going down. So from that perspective, there is, and this whole thing of renewables as a sector being funded by some of these financing companies is an altogether new game, because renewables as a sector is going to give you much more volume growth and probably at decent margins, because everybody wants to kind of get to the post faster. So from that perspective, I don't see any let up in the kind of steam that they've seen. There has been a lot of money that's been made, but that doesn't mean they can't continue to make money. So my sense is you'll probably continue having them in the portfolio. The metering solutions subset, Nigel, is definitely straddling on just a few names. You have a Genus, you have an HPL Electric, and you probably have Tata Power, which does this work as well. I think it's time to start looking at all of them individually, because all of them will get orders which will grow beyond the critical mass that they need. But execution is going to be a big key issue with them. It's not so easy in India to get acceptance and meters installed and actually getting them to be functional and operational. I mean, it'll take a lot of time for that for the rollout to kind of crystallize into some positive numbers. So we'll wait for that. But yeah, it's a great space. Genus has run up a bit too fast in my view. You'll probably see some salience from that business coming in a more diversified play like Tata Power. But otherwise, very, very promising. Next stage, we'll probably at some day we can talk about vendors who supply to electric meter manufacturers. That could be, there are magnets makers, there are diode makers, there are people who make lots of other components which also go into metering. So we could probably look at that.
Prakash, thank you very much for joining in. Have a lovely weekend. By the way, there is a recovery in the Glenmark twins. Remember, there was this deal struck between Glenmark Life and Nirma, where Glenmark Pharma has reduced its given up a controlling stake in Glenmark Life. The stocks opened up weak, but now look at Glenmark Life. From the day's low, it's recovered about 5 to 6%, and even Glenmark Pharma still trading in the red, down 3%, but at the session lows, Glenmark Pharma at one point of time was down close to about 6%. This deal is seen as a win-win for both the entities. Glenmark Pharma post the deal is going to be cash positive, likely sitting on a cash of 500 crore rupees. And for Glenmark Life, the street does see synergies focus coming in from the Nirma Group. Amit Gupta, Senior VP and Fund Manager at ICICI Securities, is with us on the show. Amit, did you ever hold Glenmark Pharma or Glenmark Life in your portfolio? And would you now be interested in either of these stocks if you did post the deal?
No, actually, we are not holding any pharma name in the portfolio. Rather, we are focusing more on the chemicals because they have come down. And I think there possibly the opportunity is coming. We had seen that before because of the export lowering numbers, those stocks had come down. But now you are seeing in China, some of the manufacturing units, they have trimmed down the production. And that is why some chemical prices, commodity chemicals or something, they have started moving higher. So that is where I think if you have to see the risk reward perspective, then I think it is better in the chemicals now.
All right. Hi, Amit. Good afternoon. Amit, the hotels, all of them have run up big time. And now maybe the best season is coming for them. You have the World Cup. You have a seasonally strong quarter as well. I mean, any of them still have that kind of room to move up from here? You're already seeing high ARRs, already high occupancies. Any of them are still looking good?
So I think we are very positive on Lemon Tree. Because if you see the average room rate, so it has grown by almost 9% year on year. And that is why when we look at the revenue per average room, it has grown by 17-18%. And I think going forward, they are saying that per annum 15-20% of tariff rate increase can be seen. And that can continue for 4 years. And that is why the hotels which are carrying some kind of debt, we can look at. Generally, we avoid the debt companies, but when you are increasing the tariff, that means the possibility of paying the debt also is higher. And that is where the alpha comes. And I think Lemon Tree, which was, near the supply area of 9,500 for a long time. So this supply area after the IPO, because after the IPO, we saw the stock moved up and then declined. So it was there only, and there actually, I think such kind of fundamental triggers are coming. And going ahead, you rightly said the wedding season is coming, the World Cup is there, the tourism centers are opening up in India from the Ayodhya temple, and I think that can lead to more boost. In fact, one more key thing in Lemon Tree is the opening up of hotel near the Mumbai airport. So that also is awaited, and I think it is going to happen very soon. And this is where I think the luxury segments which are performing, premium hotels are performing, the number of unicorns which are 108, they are going to be 250 by 2027. So where this promoter money is going to be, it is going to be parked, I think, in some kind of tourism related space, which are definitely in premium. So Lemon Tree is one of the beneficiary of that.
Aurika, that's the Lemon Tree Hotel, which is coming up near the Mumbai airport. And according to the company, it's likely to be a crown jewel for Lemon Tree. Aurika, that's the new property coming up near the Mumbai airport. Amit, is Maruti one of the stocks that you're interested in? Because even as the small car, the passenger vehicles, the entry-level segment may be hurting and there is stress, the company is increasingly gaining a lot of share in the UV market. In fact, we chatted with the management yesterday, Shashank Srivastava, and he said Maruti is on track to have a 25% market share in the UV segment by the end of FY24. So that's going great guns for them. And Maruti today is higher by 2.5%. I think Citi raised the target price further on Maruti. Do you like Maruti? And is it attractive at these levels of 10,500?
So I feel some run-up has already come in. So if you see, it had spent a lot of time near 8,000, and that was a level actually where it was supposed to be bought. Because I don't think that kind of superlative growth you are going to see in Maruti. Yes, it can give you returns, but not the kind of alpha that you are looking for. I think that is possible in those segments which are totally into SUVs, or possibly the auto ancillary space now, which is coming out. I think that is where, our much fast pace of returns can be seen. So in our portfolio, we have Mahindra and Mahindra. We believe that 1800 kind of levels, the stock is immediately, moving up. It has already spent some time now. The focus on SUVs and the tractor segment also is growing, because tractor is not only related to the farming land now. If you see the in the Punjab and all, generally we have seen the corporates also, they have started, buying for inside internal city. So it is also linked with the capex story now. So this company actually is on a high growth phase. In fact, if you look at in the auto ancillary space, one of the stock which has come down because of little higher crude prices is Apollo Tires. I think very, very attractively valued stock among the tire companies. And when the situation arises little adverse, then the opportunity also comes in. And that is what we can look at in some of these companies, because we don't believe the crude prices are going to stay, fall long higher, because ultimately it is driven by the supply cut. It is not driven by the internal strength. And that is where eventually you will see that the crude prices may be cooling off after a while. And that is where the companies which have come down because of this and which are moving into a high growth scenario, one of them is Apollo Tire, that we can definitely look at in this particular decline.
On Maruti, I'm just wondering, brokerage notes as well, or is the street sniffing something more on that one? Because that's showing some strength for the last couple of trading sessions. Amit, what about the PSU banks? People who didn't believe in it, they've actually missed out on one of the biggest rallies. They've cleaned up their books. There's been good credit offtake as well. And there was valuation comfort. But post this recent run, is there still some value? If yes, which PSU bank do you like the most?
So I think when the bond yields remain subdued, then PSU banks are one of the best bets. If you see from May 2022 onwards, despite the repo rate increase from 4% to 6.5%, the 10-year GSEC yield has remained below that level of 7.6%. In fact, it is 7.15%. And we have seen the US bond yields have gone much higher, sharply higher. So when the bond yields are subdued, it is definitely the time to look at the PSU banks. And now you have seen that possibility of the inclusion after another, 1 year or so. So that is another one which can bring to, the move. Along with this, I think one fundamental reason is if you see the credit growth in the banks, it is around 15%. But if you see the corporate lending book, it is only growing by 6% because it is just picking up now. Because private capex remain very slow in India. It was more the government efforts on infra and the public capex was more, but that has driven to some kind of demand surge, and that is why the private companies also are moving in and having more capex. So once your corporate lending book grows, I think the PSU banks, they do much better, and this is the reason that whatever declines are coming in, we are seeing a faster move despite that the elections are coming in, and generally the risk is that the freebies and extra these kind of things can be given actually by some of the parties. But despite this, if they are covering, I think it shows the internal strength.
We'll leave the conversation here for now. Amit, thank you very much for joining in. By the way, markets are moving to the day's low now. 19,664 was the intraday low on the Nifty, and we are virtually there. So this has been quite a reversal in the markets and quite a fall in the last 2 hours at the day's low. The Nifty Bank, as we highlighted, has also slipped into the red. The picture on the European market region is also fairly weak. The CAC is down 0.6%. The DAX is down close to about 0.3%. And all these indices are down anywhere between 2 to 4% for the entire week. So the global weakness continues, and that's putting pressure on the Indian markets, and risk aversion is very much there. Get into a break. On the other side, before that, we've got Nimesh waiting by for our special segment, D Street Chatter. Nimesh, is today a bit of a disappointing session? Because somewhere in, mid-morning, we almost thought that, the weakness in the global markets will be overcome by the positive news in the bond front, and markets were in the green.
Yes, Masana, it's been an extremely choppy day of trade. We saw 60 point up, Nifty rallying as well, and now we've almost given up and we are down 70 odd points. So a swing on both sides. But again, the positive news of the bond index inclusion got only rubbed into the PSU bank stock. That's the only pocket which is doing good post the market opening. The PSU bank index is up 3 odd %, and the individual stocks are also up and on good volumes as well. So that clearly stands out as far as the today's move is concerned. Even outside the PSU bank index or on the overall market, some bit of profit booking is clearly visible. The pharma index is down today. A lot of pharma stocks are under pressure, and so is the case with some select technology names as well. So that actually sums up the overall mood as far as market is concerned. Even in the broader market, while the broader market is relatively outperforming, there is a sense now that some smarter HNIs are looking to book profits and are actually sellers in the broader market. So the index may look strong, but there is supply in the broader markets from the HNIs, and from the overall market perspective, the flows are quite mixed, but the clear standout is the PSU Bank Index.
Got it. All right, PSU Bank Index. Nimesh, what about individual stocks though? What are you picking up?
Well, actually, in terms of individual names, the first stock on my list is Cholamandalam Holding, which is the holding company of the Chola Group. The stock is under pressure today on the back of some large blocks. I understand the promoter entity was a seller in today's block, and a long-only FI was a buyer. Now, as far as the promoter entity is concerned, I believe it's largely to do with the settlement within the family group. So one of the promoter entity, as part of the settlement, has sold in today's block. So that exclusion could be quite interesting in Chola Holding. So that's the first one. The second stock is Vaibhav Global. Again, we don't talk too much about this stock, but the stock is buzzing in trade today and on decent volumes as well. I understand a corporate development is round the corner. A potential acquisition in the US could be on the card. So that's the reason why some sort of excitement in that stock in today's trade. The third stock, it's basically Tata Communications and Bharti Airtel. Bharti Airtel, I've been highlighting for the last few days that there is strong buying interest back from the large institutions. Tata Com stands out today purely on back of buy flows. So the stock is not reacting today, but there is accumulation happening from a larger FI in Tata Com as well. And the last stock is Hutco. The whole theme of this PSU buzzing, continues. Today, Hutco is on HNI radar. A lot of, there is a strong buy flow as well from larger HNIs, is what I understand. But again, it's a low liquid stock. If you look at the shareholding pattern, government plus LIC owns close to 86, but that stock is buzzing on the back of HNI flows.
Thank you, Nimesh, for that interesting list. As always, get into a break. On the other side, we'll get you a few BTST calls from our technical experts. Stay tuned.
Welcome back. You're tuned into Closing Bell. Well, the markets have moved to the low point of the day, and it's yet again the big boy HDFC Bank. And my colleague Hormuz was telling me earlier today that with this fall that we've seen on HDFC Bank for this week itself, it's lost close to around 1 lakh crore in terms of market capitalization. The stock moves to the low point of the day, and just take a look at that. It's almost a replica, with what goes on with the HDFC Bank and the Nifty because of its large weightage. Maybe we can switch that plate around as well. Replace Nifty with the Nifty Bank. That as well will tell you the story out there, because that as well was up close to around 400 points at one point of time. And now the Nifty Bank has moved to the low point of the day. Just identical out there as well. The largest weight on both those two indices is not able to perform, and that's what's putting some pressure. Mitesh Thakkar is back with us. Mitesh, another disappointing trading session, right? But if you had a short call, what would you do?
I think, we'll stand on to it because the Nifty, despite the fact that the bank Nifty did very well, the Nifty has now started firmly closing below 19,750, 720 zone. So to me, that should suggest a possible test of 19,400. The only risk to this is that, we've had about 4 negative closings and we have dropped off about 600 points from the highs. We could give a pullback, but I think those will be intraday pullbacks, and therefore those will be rallies to possibly you would want to sell into. So stay negative on the indices. On the stock side, I have one buy and one sell. Astral is something which is breaking down. So sell here with the stop at 1865 for targets of 1790, and BTSC on Asian Paints, which I would recommend taking long positions with the stop below levels of 3263 and a target of around 3300 for tomorrow.
Okay. All right. Thanks a lot for that, Mitesh. Well, the markets are still lower. It's actually gone down as a disappointing trading session. The Nifty Bank, well, that's the one that's worrying. And Berger Paints, because of that corporate action, well, that's one of the stocks that's outperforming. So pretty good going out there. From the Nifty pack, let's see if anyone is trying to fight for the bulls. Nestle. Pull up the intraday chart of Nestle. It's not a large weight, but that seems to have spiked up a little bit. So pretty good going out there. Nestle has moved to the high point of the day as we speak. Independent market expert Amrish Palika joins us on the show. Hi, Amrish. Good afternoon. Well, some people were saying we want a dip. We want a dip. Now you're getting a bit of a dip out here. Maybe there's a larger correction in store. I'm not sure. But that's when true. These sort of corrections come, you get a chance to buy some stocks. So open-ended question to you. What would be that one stock that you would recommend to our viewers?
So that one stock which I'll probably buy in this dip, although the stock hasn't dipped too much, it is Samvardhana Motherson International, which is the world's leading specialized automotive component manufacturing company. They have about 93 facilities across 21 countries and supplies to OEMs across 41 countries. Basically into modules and polymer products, wiring harness and vision systems. India and Europe actually give them about 55% of the revenue. And all the top international auto majors are their customers. And we've seen the auto sector has shown excellent recovery. In fact, input costs have been reducing for the ancillary sector for the last couple of months. But I think the only near-term concern is the auto workers' strike in USA, which hopefully I think should get resolved, as US really can't afford a long-term sort of a standoff with these workers. So that's a hope for a decent bounce back in the next couple of weeks. If you look at the order book position, it's about 20 billion euros, which is about 1.8 lakh crores, and nearly 30% of this is from the EV segment. If you look at the Q1 earnings, revenue grew by about 28%, which is better than expected. EBITDA margins again were better than expected. Profits jumped about 4x to about 601 crores. And when you look at the management vision and commentary, they are talking of delivering 40% ROCE, and the revenue mix by FY25 should be about 75% in auto, and 25% will be the new products. And looking at the dividend payout policy, they're talking of 40% payout of the consolidated profit, which is extremely good. So my expected EPS for FY25 is about 6 rupees, with a target of about 120, which is about 23-24 rupees from the current levels.
Amrish, afternoon. Dabur is a stock that you like. You've recommended it in the past on the channel. Now, Dabur held its analyst meet yesterday. We also chatted with Mohit on Midcap Radar yesterday, and he indicated that there is some rural resurgence. So previously, the gap between urban growth and rural growth was quite wide, but that's been consistently narrowing. And rural growth has seen pretty decent, pickup in July. August has been a bit subdued, but July has been strong. September has been okay. And he's quite confident about rural picking up from here on. And plus, the company has some aggressive plans about doubling the revenues that they get from the healthcare segment. They're eyeing the tea market. They're eyeing the baby care market. But the stock is done. Where do you see the stock headed from here on, Dabur?
In fact, if you see the last couple of months, the stock has underperformed. But then, now going ahead, clearly I see the rural demand again bouncing back extremely well, like the management said. And among the FMCG companies, clearly Dabur has that huge rural reach, and they've been doing extremely well as compared to the rural market versus the urban market. If you compare with the other FMCG players. And now with them getting big into the masalas and spices, I think that would be also a decent driver for them going ahead. So I would possibly utilize any of these dips because of the market also correcting. In case, I get the stock at closer to about 520, 530 levels, I think that's a very good entry point for the stock. In fact, if you're talking of longer term, I'll not be surprised if you see levels of 700, 740 plus.
Thank you. Ambrish, do stay on. We need to slip into a very short break. Here is a quick programming note. Our weekend special Editors Roundtable is coming up at 4:30 p.m. And let's quickly get you a sneak preview on what are the big themes that we're focusing on. We'll continue to focus on the big story of the day as JP Morgan is all set to add Indian government bonds to its emerging market index starting June 2024. Sonia will take us through more details on that.
We'll also put the spotlight on HDFC Bank. Is the stock at a make or break level? Anuj will give us a detailed analysis.
And Nigel will present a piece on select stocks that have moved up, but it could be largely because of limited free float. So don't forget to tune in to CNBC TV 18 at 4:30 p.m. today.
Welcome back. Well, at the bottom of your screen, our team has put out this alert. And as I said earlier, Hormuz as well had told us earlier today, if HDFC Bank goes to around 1,530, then it would mean that it's lost close to 1 lakh crore in terms of market capitalization in just 4 sessions. Remember, this week we had a holiday on Tuesday. So that one's been under pressure. But as Anuj earlier, we had said that Anuj is going to be covering this piece on Editor's Roundtable later today. Is it at a make or a break point? Anuj will join us for that analysis. But Amrish, since you're talking to us right now, what's your view? Some good quality stocks, sometimes they go through this lean period. Do you think this is one such period? And would you look to get in, or would you say, wait, let's hold on, a couple of quarters are going to be weak, so let it pass, and then I'll get in?
No, I think since the management has spoken and a number of brokerage houses have already downgraded it, I think it's there in the price to a large extent. And this normally happens whenever there's a change of management, and that's exactly what has happened in HDFC. Top that, there's been a merger. So it'll take a while for it to settle down. But then clearly I see this as a good opportunity to buy it at lower levels. And again, we should remember that now it's an elephant. Don't really expect it to run like it ran in the last 2 decades. So don't expect this to be a multi-bagger. But then, a stock like this, if you're able to pick it up at levels of anywhere between 1450 to 1500, and you get a level of about 1800, 1850 in a year, I think that's an extremely good return for a stock like HDFC Bank. And normally in times like these, whenever there's a change of management, there's normally some amount of cleanup happening. There's some amount of change of strategy. So surely it can underperform for a while, but I don't think it'll underperform for a year. So I think the next possibly a quarter or maximum about 4 or 5 months, I think it's a good time to keep accumulating the stock at lower levels.
Okay, good time to accumulate the stocks for a longer term perspective. Samhi Hotels, by the way, that's picking up some more steam, 15% higher on that. IOB is higher by 2.5%. Dhanalakshmi Bank is seeing some buying, and Z Entertainment has seen a bit of a spike. The stock was trading in the red, but now it's gotten back into the green line. Amrish, how would you view Wipro and the resignation of the CFO? Would you be a bit concerned?
I would be a bit concerned, no doubt. Someone who has been there for such a long time, quits abruptly. I think it raises some questions. So I think at this point of time, I see Wipro to remain weak for a while, and I'll not really jump into start buying.
Okay, all right. Amrish, I don't know whether you track this one, Hitachi Energy, the one that's into transmission, particularly of high voltage power. They make the equipments and systems. Do you track it? It's been an underperformer in terms of revenue growth as well as on the margin front. And it's the one that got carved out of ABB. Do you track it?
No, Nigel, I really don't track this closely, so it's a bit difficult for me to really comment on that.
No worries. All right. What about from the telecom space? People were looking at turnaround stories, and Vodafone Idea and the stock price is turned around. But still, the fundamentals need to turn around. Would you look at it, Vodafone Idea? And also the other one I'm looking at is Suzlon. It had a big run, right? From around 2-3 rupees, it went to 25 rupees. They raised some money on their way as well.
That's true.
Any view on that stock, or would you give it a pass?
Suzlon, I think, is a clear turnaround. And clearly, we are also looking at a lot of institutional money also flowing in. And balance sheet has been cleaned up. Order flows have been extremely good. You can always debate whether it's expensive at these levels or not. And surely you'll get two views on that. But if you're talking of a slightly longer term, I don't think there's any doubt that Suzlon has turned around very clearly and will continue to perform. Possibly if you buy it today, maybe you may not get an excellent return in short term. But then if you're talking of holding on for the next possibly 24, 36 months, I think you should get a decent return from the current levels, although you could possibly wait for a correction since the market is correcting. Now, if you talk of Vodafone Idea, I really don't know as to whether it can turn around unless, of course, you have a decent amount of infusion from the promoters, or in case there is someone else coming in to buy that. Although the management has denied it, that rumor was there. Based on that, it had bounced. So unless I really see a decent amount of fund like flowing into the company and the balance sheet getting repaired, I really don't see a turnaround for this stock. So I will not possibly bet my money on this. I would prefer to put that on Suzlon than on Vodafone Idea.
Ambarish, thank you very much for joining in, coming to the close of the trading day and the trading week. And it's been disappointing. In fact, this week has been tough for the markets. Every single day, the markets have closed in the red. So 4 consecutive days of losses. The Nifty ending with a cut of 65 points on Friday, a close well below 19,700. And for the week, the Nifty's lost 2.5%. The mid-cap index has lost 1.7%. And you've also had a pretty rough close on the Nifty Bank. The Nifty Bank is closing absolutely flat, but for the week, it's down 3.5%. To run you through, today's action, Wipro is the top Nifty loser after the CFO steps down. Dr. Reddy's has been under pressure. HDFC Bank is down 1.5% for the day, 8% gone for the week. In fact, for the week, HDFC Bank is the biggest loser and the biggest drag. On the gaining side, you had strength in IndusInd Bank, State Bank of India. So these stocks did well. Maruti M&M saw buying. Tech Mahindra in the IT pack stood out. And Asian Paints too, closing up with a gain of more than 1%.
Well, Rima, what a week for HDFC Bank. The stock is down close to around 8% for the week. And I'll tell you what, it was one of the weakest weeks for the Nifty in the last, I think, 7 months or so. And 70% of the fall was because of HDFC Bank, Reliance Industries, as well as ICICI Bank. It's been that sort of a week, right? A few more stocks that were in focus in today's trading session, particularly from the broader markets. Well, stocks that did well, actually. You had railway-related stocks, RVNL that was higher. You had PNB Gilts as well that was high in today's trading session. And Central Bank of India as well was higher. So those were some pockets of strength in trade today. But otherwise, a weakish trading session. You had Godavari Power and Ispat as well that did fall, was holding strong all of the week, ended under some pressure. So a weak close, one would say.
A week close, but the weekend is here, guys.
Yes.
So, that heals all the wounds for the markets. But it's a wrap and closing bell. Thank you very much for watching. Don't go anywhere. Our Friday special, Smart Money, is up next.